Microsoft and Meta just posted quarterly results, and both reported double-digit revenue growth, beating analyst expectations. And both companies are growing faster than almost anyone expected. So why did the stocks react so differently? Microsoft's stock jumped 8%, while Meta's got cut by 8% after hours. If your first instinct is one of these companies must be doing worse, you're about to see why that's wrong. So far, we've heard from 3 hyperscalers during this earnings season, and they've all said roughly the same thing. Demand for AI infrastructure is not slowing down. In fact, it's accelerating. And yet, the market is pricing some of these stocks like the boom is already over. By the end of this video, I'll show you what's actually driving these moves and why I think Wall Street is looking so far ahead into the future that it's missing what's happening right now. Let's start with Microsoft's fourth quarter results. First, with the hard, cold numbers. Revenue came in at $90 billion, up 18% year over year, beating expectations of roughly $88 billion. Operating income hit up 18% year over year, while net income was up 31% year over year to $35.8 billion. And of course, the all-important earnings per share, that came in at $4.74, beating analyst expectations by 50 cents. Now, the segment that matters most for the purpose of this video is Intelligent Cloud, or Azure. Azure revenue grew 32% year over year to $39.3 billion for the quarter. And for the full year, Azure revenue jumped 31% to over $100 billion. The first time in the company's history that Azure's revenue crossed that mark. A massive milestone for the company for sure. Microsoft Copilot reached 30 million paid seats and over 100,000 Foundry customers. LinkedIn, for what it's worth, grew 12% year over year. So be sure to keep posting about how your 3-year-old taught you about B2B sales. Anyways, here's the part that actually explains the stock's reaction. Capex came in at around $41 billion versus Wall Street estimates of $42 billion. Microsoft spent less than expected, and their gross margins came in at roughly 45%, slightly higher year over year. That's the story. Microsoft isn't just making a ton of money, they're keeping more of it too. And that matters because it proves in real time that their AI spending is translating into real business activity. It's not just money getting burned. Going into the call, people have been fear-mongering that AI was eating away at Microsoft's businesses and that the company might not have the ability to keep up. But this earnings report proved them all wrong. One more detail worth flagging. Microsoft acknowledged that about 2/3 of its Capex is going towards short-lived assets, namely CPUs and GPUs, which will eventually need to be replaced as the system overall gets upgraded. This is important to know, and I'll touch on it later again at the end of this video. Now, let's turn to Meta and look at their Q2 results. On the surface, these results look even better than Microsoft's quarter. Revenue was up to $60.8 billion, up 28% year over year, beating expectations of roughly $60.2 billion. That's a faster growth rate than Microsoft posted. But here's where it flips. Operating income came in at $18.8 billion, down 8% year over year. Net income, $15.8 billion, down nearly 14% year over year. And again, the all-important earnings per share, that came in at $6.18. Down 13% year over year, significantly missing analyst expectations of $7.14. Segment performance was still solid. The family of apps, Facebook, Instagram, WhatsApp, Messenger, what have you, ad revenue there grew 27.5% year over year to $59.4 billion. Reality Labs grew an impressive 16.5% to $431 million. And overall daily active users on the Instagram family of apps was up 3% year over year to 3.6 billion. And by the way, if you're one of those 3.6 billion people using Instagram, be sure to follow me at Lunch Money Investing. Anyways, so growth at Meta is actually fine. Engagement is fine. So here's the number that actually explains the 8% after hours drop. Free cash flow collapsed from $8.5 billion a year ago to just $784 million this quarter. That's roughly a 90% drop. Those kind of results scare investors and get people asking questions. Now, to be fair, $3.6 billion of those costs came from largely one-time charges tied to legal costs and severance from all the layoffs they've been doing. That's a real legitimate explanation for part of the gap. But even accounting for that, a 90% collapse in free cash flow is the kind of number that makes investors nervous and makes them question the spending discipline of the company, not necessarily the revenue growth or the demand. And to add to those fears, Meta isn't showing any signs of slowing down on their Capex either. Quarterly Capex came in at $31 billion, and they raised their full year Capex guidance for 2026 to $130 to $145 billion, raising the low end by over $5 billion. Mark Zuckerberg also highlighted a newly finalized joint venture with BlackRock to build a 1 gigawatt data center in El Paso, Texas, aimed at fueling model training and AI agent deployment. This is not a company pulling back. This is a company spending aggressively while its cash conversion craters, and that's exactly why the markets punished the stock today. So here's the pattern. Two companies, both growing revenue faster than expected, both telling the market that AI demand is real and accelerating. One got rewarded and one got punished. The difference isn't growth, it's cash discipline. Microsoft is proving its AI spend converts into margin. Meta, at least for this quarter, is proving the exact opposite, even with a legitimate explanation for part of the cost overages. But if you stop the analysis there, you're missing the bigger picture. You might think, hey, awesome, buy Microsoft, don't buy Meta. That's not the main point here. To go deeper, we need to take a peek at SK Hynix. And to be clear, I'm going to be doing a more detailed video about this company that just reported results later in the week, so be sure to check that out. But for now, it's important to preview the results simply to make a point. SK Hynix showed revenue growth of 257% year over year to 7.93 trillion won. And that actually missed analyst expectations of 84 trillion won. But net income, that came in at 93.9 trillion won, up a staggering 1,242% compared to a year ago. Just for reference, not that it really matters, expectations there were 52 trillion won. Anyways, margins there jumped from 41% a year ago to 76% this quarter. This is an extraordinary quarter by almost any measure, and the stock still dropped 10% after reporting, simply because expectations going into their earnings call were too high. Now, put those results in context with what we just saw. Microsoft said demand is accelerating, and their discipline was rewarded. At Meta, demand is also accelerating, according to their latest results, and discipline there is lackluster, leaves much to be desired. SK Hynix, their results blew past almost every historical benchmark, and the stock falls anyway, simply because it wasn't enough to satisfy expectations that have already priced in perfection. In simple terms, good wasn't good enough. Every single one of these companies is telling us in their own numbers and in their own words, the AI infrastructure demand is not slowing down. In fact, it's accelerating. But the market is trading these names like the boom is already in its final chapter. That's the disconnect. Wall Street isn't reacting to what's happening today. It's not reacting to record demand, record Capex, and real revenue conversion. Instead, it's pre-pricing a slowdown that hasn't shown up yet in a single data point. Wall Street is looking so far down the road, it's missing what's happening right in front of it. So where do we go from here? What do we do with this? I don't think Capex shrinks. I think the growth rate of Capex simply slows down, and the spending instead gets stretched out over more time, over more quarters, instead of being front-loaded as we've seen lately. That's not a shorter boom, that's a longer one. Everyone is talking about capacity constraints. Everyone is still talking about how demand is so high. Every hyperscaler's business is still growing. On top of that, if you remember what Microsoft said about constantly needing to update their CPUs and GPUs, that shows that there's going to be an underlying replacement cycle, and that spending is going to keep going as upgrades are still needed. Hyperscaler revenue is still booming, and the Capex spend is clearly not just money getting thrown down the drain as revenue keeps growing. We are 3 years into this Capex cycle, and I think it just keeps growing, simply at a pace that's more palatable to Wall Street. And that brings me back to the picks and shovels angle that I've talked about in this video and more in my other video regarding the memory stocks. Regardless of which hyperscaler manages cash well or poorly during this quarter, the chip makers enabling all of this keep winning. If you want a deeper cut on that side of the trade, go and check out my recent video covering Micron, SK Hynix, and SanDisk. Or if you're simply too lazy, look at the DRAM ETF. Obviously not financial advice, and I definitely would appreciate if you checked out my video. But anyways, here's the final takeaway. This earnings season so far isn't a story about who grew faster. It was a story about the market grading cash discipline while ignoring what almost every other company on these calls had to tell us about growing demand and growing revenue. Anyways, if you found this breakdown useful or even mildly interesting, please like and consider subscribing to the channel. I drop videos like this weekly. Until next time, protect your lunch money.